With that established, let's now dig deeper into order flow dynamics combined with the depth of market and cumulative volume delta, which will give us even sharper insights. If you look at this slide, you will see the distinction between a candlestick chart and a footprint chart. While a candlestick might show a large green bar, it doesn't reveal the nuanced interaction between buyers and sellers at each price level. That's where the footprint chart or order flow comes into play. Simply looking at the candlestick can be misleading. A large green bar doesn't always mean buyers are in control. The real dynamics are revealed through order flow. For instance, in this footprint chart, we can see how many contracts were traded on the bid versus the ask, revealing the intensity of buyer and seller activity at each price level. However, even the footprint chart alone doesn't fully capture the market sentiment. To gain a deeper understanding, we combine it with depth of market or the order book, which provides additional layers of insight. For example, in the following slide, we will look at a short video illustrating how aggressive buyers might be getting trapped by passive sellers using iceberg orders. This allows us to see the true strength of sellers and the potential traps for buyers. If you look at this particular slide, I have attached a short 2-minute video of depth of market with level 1 data for the US Treasury 10-year yield. I chose this asset class because it's more stable and easier to explain compared to something like E-mini S&P, which can be very volatile. For instance, at the current price level of 136.22, there are about 498 passive sell orders in the limit order book, and at 136.2150, there are about 211 passive buy orders initially. There are no aggressive orders present right now. The red column represents passive sell orders and the blue column represents passive buy orders. Aggressive orders will appear in the white zone once we play the video in the center part. As we watch the video, you will notice that at the level 136.22, aggressive buyers come in starting with 100 contracts, then 200, 300, 600, even 1400 and up to 2000 contracts, all bought at that price level. But despite this large buying volume, the price doesn't move up even a single tick. On the other hand, on the passive sell side, we see large absorption, although initially 2000 contracts and later again 2400, 2500 contracts, nearly 4500 contracts are sold in total. The price never moves beyond a certain level. Each time 300 or 400 contracts are observed, sellers reload the order book with another 300 contracts, demonstrating the iceberg order pattern. After the iceberg orders, if you look into the right side of the chart in this video slide, I have included a goal chart just to illustrate the absorption example. Even though the cumulative volume delta is increasing on the upside at the bottom of the chart, however, on the upper part of the chart shows the price which remains at the same level. This is a classic absorption scenario, much like what we observed with the US Treasury yield. In the next paragraph or the slide, we have shown the delta divergence, where we can see that there are 4 types, 2 representing lack of participation on the buy side and the sell side, and the 2 representing absorption on the buy side and the sell side. Previously, we have seen a classic example of the 4th type, where price makes lower tops or staying at the same level, while the cumulative delta makes higher tops, indicating that buyers are getting trapped. While we focus on this absorption, example, it's important to note that the other types of divergence also exist, and we have not gone through each of them in detail here. In the slide about the limit order book, it's a bit more complex, and high frequency traders use level 2 and level 3 data, often visualized in heat maps and bookmarks, which is shown here. This level of detail is typically used by large institutions, and as retail traders, we don't really always have access to that level of data. Still, we can gain significant insight from level 1 data, combining with market profile and cumulative volume delta, which we have seen. Finally, when we look at individual session profiles and composite profiles along with the price with standard deviation bands and VWAP combined with cumulative delta, we see that even without level 2 and level 3 data, we can still have a significant hedge. This holistic approach helps us understand market dynamics more thoroughly and provides a robust framework for making informed trading decisions. In conclusion, this comprehensive approach combining market sentiment, market profile, order flow and cumulative volume delta provides a solid framework for understanding market dynamics. It allows us to define dynamic support and resistance levels using VWAP and filter out false signals and make more informed trading decisions. With my 10 years of experience in the financial markets and having navigated through significant losses and learning experience, I have shared my overall insights in detail. I truly appreciate your time and attention and the opportunity to share these valuable insights.